Hey everyone, and welcome to this explainer. Today, we're taking a pretty wild metaphorical journey deep inside an industrial crypto refinery. We're going to figure out exactly how raw Bitcoin is transformed into stable, high-yield digital credit. Just imagine raw, black Bitcoin oil entering a massive, high-tech financial reactor and emerging as glowing orange digital kerosene. That's the incredible transformation we're unpacking today.
So let's dive right into this question. It's something that traditional fixed income seekers and retirees are increasingly asking as they hunt for yield in a world of fiat currency debasement. I mean, they see the massive gains in the crypto space, but they absolutely cannot stomach those wild price swings. They want the upside, but they really need stability. So is it actually possible to separate the risk from the reward?
All right, part one, raw crude. Let's take a look at Bitcoin's volatility.
Raw Bitcoin is undeniably powerful, right? But honestly, it acts a lot like unrefined crude oil. We're talking about a massive 40% trailing one-year volatility. It's a chaotic, turbulent ride that is just way too aggressive for someone who only wants stable, predictable cash flows. For a lot of people, that 40% volatility is simply the fee you pay to hold the world's best performing asset. But for fixed income seekers, that fee is just way too high.
And this brilliantly illustrates the transformation. By piping that raw, volatile asset through a specialized financial reactor, instruments like Strategy's STRC can actually compress that massive 40% volatility all the way down to a highly stable 3%. It's literally an unbelievable reduction in pressure. The contrast between these two is just fascinating. On one side, you've got this black, chaotic crude of spot Bitcoin, massive potential, sure, but zero native yield and a whole lot of stress. On the flip side, steady, glowing digital credit. These instruments strip out the volatility to create a product designed to act kind of like a supercharged money market fund. The underlying philosophy here is really simple. We don't chase yield, we refine energy.
Moving right along to section 2, inside the crypto reactor.
So, how does this actually work? Well, the process inside this reactor is essentially an elegant financial centrifuge. A company issues perpetual preferred stock, uses that fresh capital to go buy raw Bitcoin, and then, relying on the long-term appreciation of that Bitcoin, they funnel a high, steady fiat dividend right back to those preferred investors. This clever structure effectively isolates the price risk completely away from the dividend seekers, placing it squarely on the shoulders of the common stockholder.
Which brings us to section 3, refining pure digital kerosene.
Check out the strategy here. Instruments like STRC are already being used as a high-yield parking spot for capital. It acts as an 8% substitute, generating what feels like found money by totally outperforming standard 4% cash. And it does all this without the direct price risk of holding raw Bitcoin. The whole idea is to fund your life today with this yield, while your core stack of assets compounds entirely untouched. The output of these reactors is honestly staggering. Think about traditional fixed income products like money markets or high-yield corporate bond ETFs. They're stuck in the single digits, right? Well, these digital credit instruments strip the volatility to create 11 to 13% tax-efficient kerosene. It's an absolute leap in cash flow potential.
Next up, section 4, the power of daily dividends.
Normally, a traditional income product drips out just 12 payments a year. And that monthly schedule? It often causes price volatility right around those specific ex-dividend dates, because traders love to game the system. But SATA upgraded the whole process by providing a continuous, daily stream of payouts. We're talking roughly 250 cash flow events a year, hitting accounts every single business day. By transforming what used to be a clunky monthly event into a continuous daily stream, investors suddenly get 21 times more chances to reinvest and compound their capital. Plus, it drastically cuts down on the event timing risk for arbitrageurs. It just flattens out those volatility pressure gauges, building an incredibly efficient, continuous financial loop that behaves so much more smoothly in the open market. All right, let's step back and look at section 5, stress testing the machinery.
To be completely objective here, critics absolutely correctly point out that this machinery is ultimately a form of tranching. It's actually very similar to a collateralized loan obligation, or a CLO. In this setup, the digital credit acts as the safer, protected debt tranche, while the company's common stock acts as the highly leveraged equity tranche that has to absorb the initial shock of any major price drops.
And that brings up a really vital counter perspective. Industry analysts like Corey Clipston impartially warn that, historically speaking, heavily structured financial products can face brutal attacks from short sellers during panic events.
He points back to massive historical blowups like long-term capital management in 1998, warning that if market stress causes correlations to go to 1, the product's peg could just break, which could potentially trigger a death spiral of cascading liquidations across the entire ecosystem.
So, the ultimate stress test for this specific reactor is a severe drop in the raw commodity itself. Analysts have pointed out that if Bitcoin were to crash by 65%, taking it down to roughly $25,000, the equity buffer protecting the whole structure would theoretically be wiped out, approaching zero. That scenario would severely test the system's absolute limit and its ability to maintain those promised double-digit yields to the credit holders. Which really leaves us with this final, provocative thought to take away from our explainer today. As financial engineers build taller, more complex structures on top of highly volatile foundations, are these industrial crypto reactors truly the ultimate evolution of fixed income? Have we actually figured out how to refine digital energy into safe kerosene? Or are we just reinventing the structured risks of the past, destined to face a brutal reality check when the market cycle turns? That is the exact question every investor is going to have to answer for themselves. Thank you so much for joining me on this deep dive, and keep questioning what you see.